Hello, everybody. So today is a Patreon request on Pagaya. PGY is the ticker symbol. And so thank you for the Patreon member. This is my premium membership where you get a video a month. And so thank you for suggesting Pagaya for the channel. I am excited to analyze it. As always, I'll be fair in my analysis and tell you exactly how I feel about this company. So let's go. So they're an AI lender. So their mission, as you can see, is so that their partners can say yes to more great customers. It's all about lending to more people. Don't forget that one of the main assumptions in finance is that everybody wants to borrow money. It's only a matter of how much risk the financial lender, the financial partner wants to take. How much risk do you want to take? Because the assumption in banking is that you're always going to find people who want to borrow money to buy a new car, buy a jacuzzi, a wedding, whatever, personal loans. People want to borrow money. That's always the assumption. And if you're willing to take unlimited risks, you're going to have unlimited growth in how much money you lend, right? And you can lend as much money as you want. That's the assumption. The AI network that they've developed, it helps them analyze customer applications, and the goal for them is to approve more people than via traditional credit bureau reports. And they have some well-known partners, including SoFi. And I own SoFi. I'm a shareholder in SoFi. So it's also important to look at Pagaya because they power some of the SoFi personal loan business. Ally, that's another neobank that was one of the original neobanks. And they also partner with some older school companies like a US bank, like the traditional Visa MasterCard. BNPL, they do a lot of buy now, pay later lenders as well. They provide their AI service to whoever wants. And their main competitor, by the way, is Upstart. So we'll briefly talk about Upstart, but just know Upstart and Pagaya, they are the two players in AI lending that I can think of. So if a business mostly takes the form, at least on the front end, and that's where most of the revenue comes from, the form of an AI API, and the API, right, application programmer interface, it connects to the legacy bank's websites and apps, etc. And the API makes the applications seamless. You see, Pagaya plugs into the partner's bank. Pagaya is not customer facing. Pagaya is in the background. And again, the mission is to help approve more people, to help absorb the risk. And we're going to talk about that. That's about 30% of a business comes with absorbing some of that risk for their clients. So we're going to talk about this and how it works. So where's the disruption? Why Pagaya from a disruption standpoint? Well, they argue that traditional underwriting practices are outdated and they have rigid cutoffs, you got to have a FICO score of 720. And if you don't have 720, you're not going to get approved, right? It's kind of how credit scores used to work. And they say that they can do something beyond the credit score. And this is where I want to talk about this in a second, because they claim to have a very powerful AI that analyzes, that helps them analyze thousands of data points to generate tailored recommendations to make to the partners regarding credit decision. So they move beyond traditional linear regression, and they use all forms of AI to predict borrower behavior and to predict whether the borrower is going to repay or not. What's more important, though, is what's the primary source of data. And the primary source of data that they use is the traditional credit attributes. So whatever is on the credit report, what the credit bureaus collect, that's the data that they use. And they use that data to determine whether someone is more likely to repay or not, and to move beyond the credit score and to develop new metrics, new ways to accept loans beyond a credit score. And the way it used to be done is your credit score needs to be this much, and if it is not this much, then we're either not going to lend you or we're going to lend you at an outrageous interest rates. They're trying to move beyond the score. But they don't use alternative types of data. And the reason why they don't use any alternative form of data is because it might raise issues with US fair lending laws. So they don't use any other forms of data. At the beginning of this, I would assume you could have the API, right? The Pagaya API log into other forms of data that the customer has. And no, they just base it on the social security number and on the credit score, and they just compute the data collected by the credit report. They compute it differently and they compute it better. And so this, of course, raises the question of the moat. If they use the same data than the one that is on the credit report, and they brag about moving beyond traditional regression analysis, well, A, couldn't the credit bureaus just do that? Or B, couldn't just the banks just do that? And so this is where we have to talk about maybe the bloat that's going on at banks, because in theory, banks could easily do what Pagaya does. I mean, banks could just you still have to go for the credit bureaus, so you still have to pay for that credit report. So banks couldn't they just take the credit report from their customers and just analyze it on their own with their own in-house developed AI? So why can't the bank implement its own AI and analyze the credit bureau data on its own, right? Why can't the bank itself move away from simple linear regressions? Oh, and that's based on the credit score of a simple linear regression, right? It's like it's very simple math, and I would argue that any person with a short data analytics training, and any person with just a little bit of marketing research training can easily move beyond linear regression, right? And can certainly do much better, right? Hire a student from some data analytics program. You'll be able to get out of your own way and do better than just the basic credit score. But then again, is this true, right? In bloated institutions, if a bank is a bloated institution, I'm not sure they can actually move beyond. If you look at I don't know about the credit team at US Bank, but they've probably been there for decades, right? I mean, these institutions sometimes have a hard time getting out of their own way, and I'm barely exaggerating, but it's similar to say the FDA approving drugs based on Group 1, Group 2 t-tests, and they just do t-tests, and they've not really moved into the modern world of recommender system and modern statistics in order to assess, say, things like drugs at the FDA. It's still based on old techniques. Yeah, perhaps banks still analyze the credit applications on old techniques, old rules that are only there because of structural inertia and inertia, and it's the way we've always done the business, and they have no choice but to bring outside expertise to change, because in-house they could never change, because the in-house knowledge just perpetuates itself and just goes on and goes on, and it never ever changes. So I guess the point I'm trying to say is that I have no doubt that the banks kind of need a partner to do that, because sometimes it's tough for the banks to get out of their own way and to innovate on their own, because banking is not a very innovative industry. And not everybody can do innovation a la Elon Musk style. And you got to ask yourself, there's been major issues, for example, in risk management at banks like SVB, did they actually operate on modern standards of stats and modern ways to analyze the data? I don't know if that makes any sense. Hopefully that point makes some sense. If every fintech, if every bank was run like an X or like a Pagaya, I'll put a Pagaya in there would be no need for a Pagaya, but they're not, because it's the banking world is a game of isomorphism. It's a game of perpetuating tradition and keeping going the way it always has. And so they need a partner on the side to implement that AI, because the in-house teams may not implement fully that AI. And this is also why it's surprising to see SoFi in there, to see SoFi as a customer of Pagaya. It's surprising. And so there may be another reason why, and I'll get to that in a second. There may be another reason why, because, so before we go out, let's talk about the revenue. So the revenue up, that's great. and the operating leverage is kicking in, right? So if you look at the operating leverage, they grew their adjusted EBITDA by 98% year over year. Revenue only grew 21% year over year. So they are in that phase where they're growing the proxy for free cash flow, which is adjusted EBITDA. They're growing it faster than revenue. So they are past that J curve, if you will, and they're now growing the revenue. It's a profitable company from an adjusted EBITDA standpoint, which is what I care about. Now, going back to how do they make money? Well, this is where it gets interesting. They make money today, 71% from the AI fees, 29% from the issuance of investor products, and that's the risky part of the business. That's the absorb the risk part of the business. And my guess is that a lot of these companies are doing business with Pagaya because Pagaya, as a way to absorb the risk, some of that risk is offloaded by Pagaya, i.e., some of that money is lent by Pagaya and securitized on the back end by Pagaya. Pagaya takes on some of the underwriting risk, and this is why. I mean, again, I'm speculating here, but I'm guessing a lot of customers see a benefit in Pagaya taking on some of the risk in addition to the AI lending. And in fact, in the early days, the product was mostly about Pagaya taking the risk. And you see, they've been trying to take on less risk and shift the revenue mix towards more fees and earning more fees. But it seems to me like they've plateaued in the 30% range here. I don't know how much lower they can get. Are they always going to have 25% of their money, of their revenue? Is it going to have to be investor product and repackaging the loans? Because that's an essential selling point to selling the AI integration product. The AI integration product, one of the essential selling points may be that Pagaya is able to absorb some of that risk for the bank, so the bank can unload some of the risk. And knowing SoFi, that would be my guess. My guess is that a partner like SoFi unloads a lot of the risk on a company like Pagaya, and perhaps a company like US Bank, for example, is more likely to just pay AI fees, right? Same for BNPL. The BNPL lenders who use Pagaya, they may be much more likely to pay the AI fees. Of course, in this business, I would much rather to see the AI fees, nearing 100%. The goal over the long run, what I would love to see is the AI fees being 100% and less lending, because, and this is where I'll get to my video here again. So this is their asset-backed securities program. They issue the securities and they sell those securities, and between the time they issue the securities and the time they sell them, and depending on market conditions, they have to keep some of those securities on their books. And this is where some of the risk may lie, because you have to keep some of the securities on your book. And so when you start looking into the 8K and you look at their current assets, you can see investments in loans and securities, it is $912 million. So when you look at the balance sheet, a whole lot of the assets on that balance sheet is in the form of loans that they've issued. Their notes, they own the notes. They lent money in the form of a personal loan to someone who wanted to, I don't know, go on a honeymoon vacation or whatever. And that's a note, right? They lent a note on a car, and that note is, oh, well, the person is giving me the promise to repay that car. And of course, there's two risky problems, which is, by the way, it's one of my criticism too, that one of the reasons why I'm not as heavy in, say, SoFi as I could be in other stocks is because there's risks involved with owning these debts and repackaging the debts. This is also one of the reasons why whenever I talk about Stonia on this channel, I don't like to see them get into lending, because it's very non-transparent, if that makes some sense. Like $912 million, okay, so that's what they value their notes at. But when you go read the disclosures, right, you can see that valuing these notes the estimated value on their asset, which, it's pretty darn important what value they carry the notes at. The estimate of fair value of these assets requires significant judgment, and they use the standards method of judgment to judge the value of the assets. But this is a problem that I have, like if I look at a car, if I look at a GM, for example, General Motors, if I look at the balance sheet, I go on GM Financial and I look at the value of the notes, and I'm like, they hold these notes as assets, and there's no way in the world that this is $90 billion worth of notes. We are being too optimistic. And I'm not saying this is what Pagaya is doing, of course. I'm just saying there's a lot of trust that has to be placed in the value of the notes. And you know that if you look at the banking system, and if you look at, held to maturity notes, they've lost a bunch of money on these bonds, a bunch of money on these notes, but they get to keep them at the principal value. They get to keep it at the value issued, and they don't get to recognize the loss, even though those bonds have technically taken a huge loss. So it's all about the appreciation of the accountant, what is going to be the value of these loans. And to me, this creates a lot of uncertainty. This is why I'm in general wary of the banks, and I'm in general wary of any company keeping too many loans on the balance sheet. And this is where, of course, these metrics could sour, so they seem to be doing fine. So you can see in the blue line here is their average coupon, right? So and look at that, right? The personal loan average coupon is over 20%, right? Same for auto, it's over 20%. So they really lend to people, for a bank, when it's when someone has an 800 credit score, and they show up and everything looks good and they can approve, they don't need Pagaya, right? They need Pagaya when you have someone who's at the edge. They're coming to see you, they have a 650 credit score, and getting them approved is edgy and riskier, if that makes some sense. So that's why they're able to earn such a high return on these loans. But the question is the delinquency, and you got to see the direction of the delinquency. And I would argue it's been roughly flat, way down compared to where it was in 21 and 22, but it's ticking up a little bit. If you do 1Q to 2Q, and same here, 1Q to 2Q, it's ticking up a little bit. So the question is, do you think the delinquencies are going to go up on the personal loan portfolio and on the auto loan portfolio going forward? I have no idea. And another point is their model getting better at lending? And of course, the better the model gets, the more the model ends up denying, and the more the model ends up denying people, the less quick you grow. So banks and Pagaya, they grow at the speed that they want. They pick the speed at which they want to grow, depending on how much risk they want to take on. But it's always a risk to me when I see nearly $1 billion being held on the balance sheet, and you have a company whose market cap is not even that, and we'll get to that in a second. So anyways, securitizing their loans, are they having success? Well, kudos to Pagaya. Yes, they are having success securitizing the loan. There is demand. You can see this is one of their latest deals, November 6th. They raised $1 billion for a personal loan and auto loans, and you can see it was oversubscribed with 28 investors. So this doesn't seem to be a concern. They are having demand. I also want to address this. This would make me mad as a shareholder of Pagaya, if I was one, because if you read these headlines, this is an existing shareholder selling shares. So Pagaya is not diluting. There's no dilution here going on. There's no dilution, but it's reported in the financial media as though there's going to be a huge amount of dilution. They are not selling shares, but you would think the reporting would distinguish. You would think the reporting would be no, it's not. It's very annoying. It's very so this would annoy me. This is this is just the financial news cycle, and this just creates a lot of volatility on the stock. But this type of dilution doesn't impact. Now, to be fair, there's been a little dilution in Pagaya in the form of stock-based compensation, but frankly, it doesn't bother me. It's not that bad. I mean, over the long run, it's not that bad. Of course, in the early days, they diluted more, but they were going public, so that was understandable. It doesn't bother me too much, but I usually take it easy on the dilution. I'm not the type of person who frowns upon dilution too much. Let me move on to valuation. So we have Pagaya and we have Upstart. So let's go. So, and I put Upstart in there because the Patreon member asked me to compare with Upstart and kind of say, talk about the competitor, talk about Pagaya. So the company, the market cap is 710 million. Upstart is 6.6 billion. So there's a huge delta here. But look at the revenue. Pagaya has greater revenue. Pagaya has 971 million in revenue. Enterprise value of Pagaya is 1.24 billion of revenue. So again, we gotta check these numbers. This is a financial company here. So I'm trying to understand why there is that delta. That may be a mistake. But anyways, check those numbers. But it's roughly $1 billion company. Roughly $1 billion company. They're growing revenue at 16%. Okay, gross margin is 41%, EBITDA margin is 7.4%, enterprise value for revenue is a 1, roughly. So we're roughly at a 1, but the company is trading at roughly 1 times sales. Okay, so that's pretty good, and enterprise value over gross profit is 2.6, EV over adjusted EBITDA is a 17, so cheap. Okay, and how much am I paying for that growth? That's the big question on this channel, right? Enterprise value over gross profit over revenue growth. I ask the question, how much am I paying for that growth? I'm paying a 0.2. So the stock is inexpensive. It is not the least expensive stock out there. It's not, I mean, it's in the top quarter of the inexpensive stocks. And unfortunately, because of the EBITDA margin and because of the revenue growth being on the lower end, they don't achieve a rule of 40. They have a rule of 23, and you know that I try to find stocks that have a rule of 40 and that also grow their revenue at more than 30%. But again, keep in mind, this is a company that can lend more money. The more they lend, the more revenue they earn. That's the nature of banks. They kind of decide the speed at which they want to grow. And you can see that they've had a period of flattish revenue, but they are getting back into the growth and getting back into growing. And so depending on the Q over Q number that you look at, at some point it was 27%, right? So it could be higher than 16, depending on what you say. 16, that number comes from the analyst. They may be very well growing at 25% over the next 12 months. The analysts could be off. And in that case, the stock would be even cheaper. In sum, revenue growth has been okay, but I think that the revenue growth is not nearly as high as it could be. Why? Because of the Fed, right? And that's another question is, who wants to borrow at 10% for a new car? Well, that's the thing. Pagaya wouldn't be involved in that 10% loans because the 10% loan for a new car is for a good borrower, right? The better question is, who wants to borrow at 20% for a new car, or 15 or 16% for a new car? So let me just change that. Like, let's say 16. Who wants to borrow at 16% for a new car or kitchen remodel? Very few people right now. That's the problem, because people still remember the days where you were driving around in the highway and the local credit union was advertising a free 99% loan, a 3.99%. I remember those days. That was 2 years ago. People's memory is still here, and so maybe it's gonna take another year for people to forget that the rates used to be much cheaper before, and for people to get used to the new rates. And we have to talk about the roller coaster. This stock has been a volatility roller coaster. I mean, it was in August, let's call it August of 2023, so a little more than a year ago, it was 31, and now it's 10. And if you go back in April, in the early days, it was near 20, not quite, but near 20. So this stock has been very volatile. Year to date is down 32%. Very volatile company, and again, that's why, if the stock goes back to 30, my numbers may not look as cheap and not look as good. And again, this is what our Patreon member wanted me to ask, is what I think of Upstart versus Pagaya. Well, I don't understand Upstart. I cannot understand why Upstart is so expensive, because they're predicted to have their revenue go down. The gross margin is better, but their EBITDA margin is way down, which tells me that there's something going on either in R&D or in marketing. They're spending a lot of money somewhere. I don't know where that money is going. Upstart, are you issuing a lot of stock-based comp? I don't know what is going on, but that's minus 24%. And so I can't calculate any of these because it's a negative rule of 40. And I can't calculate an EV over GP over RG because you're not growing. So how much you're paying for that growth? Well, you're not paying anything for the growth. There's no growth. There's a decline. So I don't understand why Upstart has performed so well. It would warrant its own analysis, but I'm not going to be analyzing it because it doesn't even fit my criteria in my screener. So that's kind of how I decide when I analyze stocks on my own or not. They need to be attractive in my screener for me to pay attention to them. So my final thoughts. Why is the stock so cheap? Why is there such a discount in Pagaya? And I remember talking about this stock maybe a few years back as part of a screener where it was on a screener, and I briefly discussed it a second, not a deep dive like this. But I remember it was cheap back then, and it was actually in penny stock territory, I guess is what you could call it, back then. And so they did two things. One of the things they did is they did a reverse split back in March of this year. They did a 1-for-12 reverse stock split. And so shareholders, the market typically tend to not look positively at reverse stock splits. So that might be a reason for the discount. Another reason for the discount is that it's still identified as a Israel company. And Israel companies, and I've covered them on the channel before, there is a discount. They are trading cheaper, and that's where, if I tell you, of course, Upstart, I'm going to tell you it's in San Mateo, which is in Silicon Valley. So you have the Silicon Valley startup. And in the case of Pagaya, they are located in Tel Aviv. Now, they moved to the US, and now their official headquarters is in New York City. And when you look up on all of the trading platforms, it shows up as a US domestic stock in New York City, but they have two offices, one in New York City and one in Tel Aviv. And so I think this may be one of the reasons why the stock is cheap, is because there is still an Israeli stock discount because of the geopolitical developments. I've covered that discount, and so that might be another explanation. So two explanations: reverse stock split and the association with Israel might be reasons for the discount. And of course, Upstart is Silicon Valley, so Upstart is gonna it's I guess the world's not fair as far as valuation goes. If I had to invest in this sector, I would prefer Pagaya any day over Upstart. I mean, I don't understand Upstart. I don't understand the numbers. Like I can't get it. I think it's so expensive. I would prefer Pagaya any day over Upstart if I had to invest in this sector. If I held the stock at a higher price, I would probably keep them because that's too cheap. And you probably heard my my rumblings about StoneCo and what I'm doing with StoneCo. Well, I'll give you a hint. I'm probably keeping StoneCo because StoneCo is too cheap. And I don't sell stock when they're that cheap. It's just too cheap. So sometimes I become a value investor against my will. Pagaya would be an example of me becoming a value investor against my will if I were to own it, because I'm a growth snob and I want companies to grow fast, and the growth for Pagaya is too slow for me. At analyst number predicted to grow 16%, revenue growth 16% next 12 months. That's too low for me, and they don't achieve the rule of 40, which of course they don't, because you're only growing at 16% revenue, so you wouldn't achieve rule of 40 with only 7% EBITDA margin. So again, that's a new metric, but that metric, rule of 40, is very easy to achieve for my stocks usually if they grow at 30%. It's very easy because they only need 10% of EBITDA margin, so they typically achieve it, right? But I'm invested in a related sector. I own these two, and I prefer these two. It's SoFi and Nubank. Nubank is in Latin America. It's the leading neobank in Latin America, and SoFi is the one of, do I say the? Because you have Cash App, but Cash App is technically a financial technology company. SoFi is a bank, but it's also a tech company. So anyways, I prefer these two, even though they're slightly more expensive on EV over GP over RG. They handsomely achieve and exceed the rule of 40, which is why I prefer these two. There's also the point that I made with Celsius recently and with other companies recently, where I prefer the companies that I invest in to have a direct access to the end customer. Pagaya is a supplier. It's a supplier of AI services to banks. It's the bank who decides, and the bank may at some point decide, okay, well, I adopted Palantir in the house. I just adopted Palantir, and one of my software engineers built a model based on the credit score reports. And really, I'm fine using that model. I'm just going to use that model, and the extra risk, I'm just going to take on a share of it. That could happen, and then they decide to replace Pagaya with some in-house service. And that's something that I've come to discover, studying Celsius, not discover, but be more aware of, studying Celsius, studying ELF, which is, at the end of the day, I want to have access to the end consumer. And having dozens of big customers is not the same as having millions of small customers. Millions of small customers is much stickier than dozens of big customers. And if you lose a big customer, boom, you lose 5% of the revenue or more sometimes. So that's that concentration risk that I don't like as much. But nonetheless, there's no denying the stock is cheap. So hopefully you like my analysis of Pagaya. Overall, there's more positive than negative on this stock, more positives than negative, and it is definitely a cheap stock, so it qualifies for analysis on my channel because it's cheap. So this was not financial advice, not investment advice, just entertainment. Hoping you were entertained. Please like, please subscribe. Thank you so much for watching, and have a wonderful day. And thank you again to the Patreon member who sponsored this video. No financial advice. Thanks for watching. Have a good day.